Welcome to the Deep Dive. Today, we're diving headfirst into distributed ledger technology, DLT.
Right, specifically how it might reshape capital markets, securities mainly.
Exactly. And our guide for this, it's a really comprehensive report from the Global Financial Markets Association, the GFMA.
Yeah, impact of distributed ledger technology.
Very
They got some heavy hitters involved too. BCG, Carath, Clifford Chance.
So it's got weight. What's really compelling about it?
I think it's that it looks at both sides, the exciting potential, but also the real practical stuff. It tries to get past the buzzwords.
Right, the opportunities and the risks for securities, for payments using DLT.
Mm-hmm. A proper evaluation.
So for you listening, think of this as your shortcut, understanding the real progress, the promise, but also the roadblocks DLT faces in finance.
We'll try to cut through the jargon, focus on what really matters.
The big question the report asks is basically, can our current system's legal, regulatory, risk management actually handle this tech?
And, what are the real tangible benefits, if they can? What does a DLT-based system actually deliver?
And those potential benefits are pretty eye-catching.
Oh, yeah.
They're talking cost savings.
Yeah.
Something like $20 billion USD a year, just in clearing and settlement.
That's the estimate. And it's not just plucked out of thin air. It comes from streamlining all those reconciliation steps, maybe needing fewer intermediaries after the trade.
Right. Think about all the checking, the error fixing. DLT could cut a lot of that out.
And then there's the other big number, the potential for a $16 trillion market.
$16 trillion.
For tokenizing assets that are normally hard to trade illiquid assets. By 2030, potentially.
Which probably connects with things listeners might have heard, right? News about tokenization pilots, talk about efficiency, new asset types.
Yeah, absolutely. It's all part of that same conversation.
So our mission today, pull out the key insights from this GFMA report, give you a clear picture of where DLT is now in capital markets and where it might be heading, without hopefully overwhelming anyone. Okay, so let's dive in. Where are we actually seeing the early wins? The concrete benefits?
Well, the report points to some really interesting early uses. Project Mars, for example.
That was the European Investment Bank bond.
Exactly, the EIB. It showed how DLT can make things more efficient, boost liquidity, especially for things like corporate bonds.
So this isn't about tearing down the old system right away.
No, not at all.
Yeah.
The idea, at least right now, seems to be building a kind of parallel system, a complementary one.
DLT working alongside the traditional rails.
Right, a gradual transition, less disruptive.
That sounds, more practical, safer maybe. What other benefits are popping up?
Broader market access is a big one. Fractionalization,
Breaking assets into smaller pieces.
Yeah. DLT makes that easier, technically.
Yeah.
So you can lower the minimum investment needed, opens things up to more people.
And getting assets to market faster. Time to issue.
That, too, for certain assets, could speed things up quite a bit.
Faster issuance, lower minimums. Both sound like potential game changers.
Sure.
Didn't the report mention something specific about collateral management?
It did, yeah. HQLX. They have this digital collateral registry.
Built on R3-Corda, right. A private DLT.
Yes. And the key thing is it allows for almost instant collateral swaps. Delivery versus delivery, DVD they call it.
So swapping ownership of securities super fast.
Pretty much. Sidesteps some of the usual custody chain delays. And that cuts down intraday credit risk for the institutions involved.
Less risk, faster collateral moves.
Okay, so it seems like these first DLT projects are really targeted, hitting specific pain points.
That's exactly what the report suggests. The initial focus is on things like bonds, OTC derivatives, repos.
Areas where there's a clear financial reason.
Right, a clear opportunity for cost savings or new business, and maybe where the market's more ready for innovation.
Okay, so DLT looks promising, some good early signs, but what about the risks? What are the specific DLT risks in capital markets? Super important question. And the report tackles it head on. The good news, maybe, is they think risk management can largely build on existing financial oversight.
So we're not starting from scratch.
Not entirely. They sort of break down the risks along 3 lines.
Okay.
First, how it's implemented.
Yeah.
Is it just for keeping records, books, and records, or actual tokenization of the asset itself?
Right, record versus actual digital asset.
Second, where in the life cycle? Issuance, trading, post-trade stuff like clearing and settlement.
Primary, secondary, post-trade. Got it.
And third, the type of network. private permission, public permission, or totally public and permissionless.
Ah, the network archetypes, that makes sense. A
Okay.
closed private network is obviously different risk-wise than an open public one.
Precisely. Private permission networks, they're more like traditional systems in some ways, controlled access, governance, but maybe less interoperable because they're closed off.
And public networks.
More potential connections, wider reach, but different risks, security, governance, that kind of thing.
And the GFMA has a view on how regulators should handle this.
They do. They caution against, and this is their phrase, punitive DLT-specific prudential treatment.
Meaning?
Basically, don't slap on extra tough capital rules just because it's DLT. They argue it could kill innovation without necessarily making things safer. Interesting point. Their view is if you have regulated instruments or even tokenized commercial bank money on a DLT, well, existing rules can probably be adapted to cover them.
Adapt. Don't just invent new rules for DLT's sake.
Yeah.
So if the potential's there and the risks seem manageable, why haven't we seen DLT just take over capital markets yet?
Yeah, that's the multi-billion-dollar question, isn't it? Despite all the buzz and the pilots, the report is clear. DLT-based securities issuance is still mostly experimental.
And liquidity.
Trading bullies.
Still low. Much lower than traditional markets.
So not quite prime time yet. What's holding back?
One big danger the report flags is everyone doing their own thing. Siloed approaches.
Different companies, different countries, building incompatible systems. Exactly. And diverging regulatory regimes, too. If the rules are completely different everywhere, it really gums up the works for building a connected system.
Makes total sense.
Yeah.
You need common ground for something like this to scale.
Absolutely. The report hammers this point. Cross-industry consensus is vital. On the tech, on standards, on rules, on the legal stuff. That's what builds confidence and gets development focused on real use cases.
So people need to agree on the rules of the road. Did GFMA suggest how to get there?
Yeah, they have 5 specific calls to action, basically urging the industry and regulators to talk more, work together, get over these adoption hurdles. Collaboration is the main theme.
Okay, collaboration needed. What about the actual building blocks? What does a functioning DLT ecosystem need? The key enablers.
Several crucial pieces. One is regulated DLT-based cash. You need a reliable digital form of money that works on these ledgers with regulatory blessing.
Makes sense. Can't settle trades without the cash leg.
Then an industry-agreed taxonomy, a common dictionary, basically, so everyone defines digital assets and actions the same way.
A shared language. What else?
Fund mandates might need updating to allow investment in these new kinds of assets. Clear global legal frameworks are essential to certainty about owning and trading digital assets.
Legal certainty globally. Big ask.
Huge. And finally, interoperable networks. We keep coming back to this. Different DLTs need to talk to each other. And maybe even new kinds of DLT native market infrastructure.
Interoperability again. Okay, let's rewind a tiny bit for listeners maybe less familiar with the tech itself. DLT, distributed ledger technology. What are the absolute fundamentals?
At its heart, the report boils it down to 2 things. 1, a distributed database. Data isn't in one central place. It's copied and shared across many participants, updated almost in real time.
Shared database. Got it. And 2.
Digital representation of assets. Tokenization, basically capturing ownership or value as digital data on that shared database.
And when we say tokenization, it's not just crypto like Bitcoin.
No, definitely not. Crypto pioneered it on public chains like Bitcoin and Ethereum, but the idea applies much more broadly. Regulated things like stocks, bonds, private debt, commodities, even regular currency.
And these can live on different kinds of networks, public and private.
Yes, exactly.
Okay, distributed database, digital assets.
Mm-hmm.
What makes DLT different from just a shared spreadsheet? What are the key features?
The report lists 4 main ones. First, that distributed architecture we mentioned, shared synchronized data.
Okay.
Second, data integrity. That comes from consensus mechanisms.
Ah, consensus. How the network agrees on what's true.
Right. Before a new transaction gets added permanently, the network has to agree it's valid following certain rules. That builds trust, stops things like double spending.
And we hear about proof of work, proof of stake.
Those are common for public networks where users might not know each other. Proof of work is solving hard puzzles. Proof of stake involves locking up assets to vouch for honesty.
And private networks.
They often use different methods, sometimes more energy-efficient ones like PBFT, practical Byzantine fault tolerance, because the participants are known and usually trusted to some degree.
Right, different tools for different situations. What's the third key feature?
Immutability, making it really, really hard to change past records once they're in.
How does that work?
Many DLTs use a blockchain structure. Blocks of data are linked using cryptography. Each block has a unique fingerprint, a hash, that includes the previous block's hash. Change an old block, the hash breaks, the chain breaks, everyone knows.
So a tamper-evident permanent record.
Pretty much. And the fourth feature is composability.
Composability.
Yeah, because the assets and the rules are on the same shared ledger, you can build applications that work together using smart contracts.
Self-executing code.
Basically, code that automatically enforces agreements based on set conditions, allows for lots of automation right at the asset level.
Smart contracts. Sounds powerful. Okay, let's go back to those network types. Private permission, public permissionless. What's the main difference for someone thinking about using them?
It really boils down to access and permissions. Who can get on the network, and what can they do once they're on read data, write data?
So private versus public access and permissionless versus permissioned action.
Exactly. Private means invite only. Public means technically open. Permissionless means users don't need specific roles or verification for basic interaction. Permissioned means users are identified and given specific rights.
So private permissioned is like a walled garden. Closed group, set rules.
Good analogy. Restricted access, defined participants, agreed rules, often different permission levels. That's popular in finance now because it offers control and security, fits well with regulation, settlement finality needs.
But maybe harder to connect to the outside world? Interoperability challenges?
Can be, yeah. Smaller user base.
Okay, what about public permissionless, like Bitcoin or Ethereum's base layer?
Kind of like the Wild West or maybe the early internet. Anyone can connect, technically. Huge potential reach, good for building broad market liquidity, maybe.
But challenges.
Big ones for regulated finance. Oversight, security risks like 51% attacks, KYCML, compliance, privacy, getting that solid settlement finality regulators need.
Right. Openness comes with headaches for regulated players. So the middle ground, public permissioned.
Often seen as a promising hybrid. It uses public infrastructure, maybe more transparent, wider potential reach, but access to the network or specific apps is controlled via permissions.
Like online banking on the internet. Public road, but you need keys to your specific house.
Exactly that. Trying to get the security and control of private networks with the potential reach and interoperability of public ones could help avoid liquidity getting stuck in silos.
Any examples?
The report mentions SojanForge using a permissioned app on public Ethereum for a bond, and R3's Cordon network, which evolved from their private platform towards a public permissioned model.
Interesting. So ways to use public infrastructure, but with controls. What if a regulated firm does want to use a public permissionless network without directly holding, say, Bitcoin or Ether?
There are ways emerging. The report mentions using permissioned applications on top of the public network, ones that handle the KYCML checks, or using whitelisting, only allowing transactions with approved, identified participants or tokens.
So layers of control on top of the open network.
Kind of, yeah. Trying to leverage the network effects while managing the risks.
Okay, that clarifies the network types. Now the assets themselves, digital assets on DLT, what does that cover?
Broadly, in this context, it's digital representations of regulated financial instruments and money recorded on a DLT to show ownership. That process is tokenization.
And tokens can be fungible or non-fungible.
Right. Fungible means interchangeable, like shares of the same company or dollars. Non-fungible means unique, like a digital artwork or maybe a specific property deed.
And how do DLT-based payment instruments fit in? Digital money.
Yes, ways to pay on the ledger. The report mentions a few. Tokenized commercial bank deposits, basically. A token representing your claim on money in a bank account.
Okay.
DLT-based deposits, more like your traditional bank balance, just being tracked on a DLT system.
Simpler representation.
And then wholesale central bank digital currencies, WCBDCs, that would be money directly owed by the central bank for big players like banks.
But WCBDCs aren't fully live anywhere yet?
Not fully launched, no. Lots of experiments, though. And usually these tokenized deposits or DLT deposits run on private permission networks for regulatory reasons.
Right, controlled environments for money. The report also distinguished between tokenized securities and native security tokens. What's the difference there?
Good question. Tokenized securities are usually existing. Traditional securities just represented on a DLT. Maybe it makes them easier to use as collateral on-chain, some post-trade efficiency.
So putting an existing stock or bond onto a ledger.
Exactly. Security tokens, though, are born digital, issued natively on the DLT from day one.
More potential upside.
Potentially, yes. lower issuance costs, maybe more features baked in via smart contracts. But bigger hurdles right now: legal clarity, regulatory status, and often much less liquidity than tokenized versions of existing assets.
So how it's created matters a lot for its benefits and challenges today. Okay, let's walk through the life cycle. Primary markets issuance. What's wrong with the old way?
The report points out it's often slow and expensive. Issuing a bond might take 6 weeks. Lots of intermediaries, lots of manual work.
Even with electronic platforms.
Yeah, they haven't fixed all the underlying issues. Structuring the deal, all the legal docs, filing still very manual, lots of parties involved, then actually distributing the securities. Another complex process.
Lots of steps, people. Potential for errors. How could DLT help?
Automation and coordination. Smart contracts could handle parts of it, reduce errors through multi-party verification right from the start.
Maybe even change who designs the securities.
Possibly. The report mentions tokenization platforms allowing more buy-side input on security design. And again, fractionalization, breaking it down, could bring in more diverse investors.
Sounds more efficient, maybe cheaper eventually. But initial costs.
Oh, yeah. Building the DLT infrastructure, the smart contract platforms, getting the right people. That's a big upfront investment. You need widespread adoption to really see the big savings.
Network effects again. Okay, what about secondary markets? Trading existing securities. Is DLT going to blow up the stock exchanges?
Probably not immediately, especially for things that are already very liquid, like major stocks. Those markets work pretty well.
Where's the bigger potential then?
Illiquid assets. That's the recurring theme. Unlisted shares, private debt, fund interests. Tokenization and fractionalization could genuinely create or deepen liquidity for these things, make them easier to trade.
Unlocking trapped value.
Exactly. And maybe enabling new things too: automated portfolio balancing, real-time ESG tracking tied to the asset, maybe faster sourcing for derivatives.
But getting these new digital markets going. Challenges.
For sure. The report mentions the risk of bifurcation of liquidity.
Meaning liquidity gets split.
Yeah, split between traditional markets and DLT markets, and maybe even split across different DLT platforms, especially for those native security tokens.
How do you fix that?
Things like automated market makers, AMMs, could help bridge the gaps, connect the pools.
But you need to build those pools carefully.
Definitely. Focus on specific use cases where you can build that critical mass, that network effect, rather than trying to boil the ocean from day one.
Long term, though, maybe fewer systems needed overall.
That's the hope. DLT could eventually simplify the tech landscape for trading.
Okay, let's move to the back office clearing and settlement. This was where those huge potential cost savings were mentioned. How does DLT change things here?
This is a really big one. DLT could potentially merge clearing and settlement into one continuous process using smart contracts.
Instead of separate steps over days.
Right, near real-time execution and finalization. Could dramatically cut down on trade fails and all the costs that go with them.
Wow. And the report mentioned trapped collateral.
Yeah, huge amounts. Over $17 trillion globally in 2022. Posted to central counterparties, CCPs, as insurance. DLT settlement, especially if it's faster, might free up some of that capital. Less opportunity costs.
And the current system is just complex.
Immensely complex. CCPs, clearing members, custodians, CSDs, lots of steps, lots of reconciliation, drives up costs, creates operational and credit risk. CCPs manage risk well, but they also concentrate it.
So DLT could simplify and maybe de-risk parts of this. What are the different ways to implement it for settlement?
The report talks about a few models, like SS0 is just using DLT for record keeping, not changing settlement much. SS1 might be DLT securities, but traditional cash payment.
Okay.
Then you get towards SS3, which is the fully integrated vision. DLT securities and DLT payments settling together on the same ledger. That's where the biggest potential efficiency gains probably lie.
Are we seeing real-world examples now?
Yes, definitely emerging, especially in areas like repos and OTC derivatives where collateral movement is key. You've got JP Morgan's Onyx, Broadridge's DLR platform.
Offering faster intraday settlement.
Exactly, reducing costs, freeing up collateral. And that HQLX DVD model again, delivery versus delivery, swapping securities directly on the ledger, synchronizing delivery without the usual chain.
So targeted improvements happening now. Okay, next step, custody. Safekeeping the assets. How does DLT change that?
Potential for long-term cost savings here too, and big demand expected. That $16 trillion projection for DLT securities custody by 2030.
How does it save costs?
By simplifying record keeping, less need for reconciling between custodians, sub-custodians, CSDs. The shared ledger helps keep everyone on the same page.
So instead of complex chains of accounts, maybe something simpler. like digital wallets.
That's one vision, yeah. Wallet-based custody linked by private keys. But the report is realistic. That's unlikely to completely replace the CSD account model anytime soon.
Why not?
Lots of assets will still be traditional for a while, and regulators might still want a CSD or similar entity as the ultimate legal owner record for systemic risk reasons.
So maybe a hybrid future. Elements of both.
Seems likely for the interim. Maybe the CSD stays the golden source record with the DLT syncing, or maybe the DLT becomes primary and the CSD's role changes more oversight, governance.
But a distributed ledger is potentially more resilient.
Yes, less risk of a single point of failure, like one central system going down.
Okay. What about asset servicing? Corporate actions, dividends, mergers, and tax stuff, often complex and error-prone.
Huge potential here, too, the report suggests. Corporate action errors cost over $1 billion a year. Tax reclaims, billions stuck in the EU alone.
How can DLT help?
Automation via smart contracts again. Handling corporate action payouts, proxy voting more accurately and quickly, maybe even automating tax withholding at source?
But tax depends on local laws, right?
Absolutely. DLT can enable it, but the rules need to allow it.
The report mentioned embedded supervision. What's that?
Building regulatory reporting right into the DLT or smart contracts, so regulators could potentially see things happening in near real time.
Sounds efficient.
Could be, but its impact is limited while DLT assets are just a tiny slice of the market. Need scale for that to be truly meaningful.
Okay, we've seen the potential across the board. Let's circle back to the hurdles. The report went into more detail on the barriers to adoption, didn't it?
It did. Group them into 4 main areas. First, operational capabilities.
Meaning?
Building the tech, integrating it, finding people with the right skills, which is tough. Creating totally new workflows, standardizing data so platforms can talk to each other. It's a big operational lift.
Not just plugging in new software, it's changing how things are done.
Exactly. Second barrier, minimum viable liquidity.
Getting enough trading activity going in these new digital markets.
Right. It's that chicken and egg problem. Hard to attract big players if there's no volume, hard to get volume without big players.
Makes sense. Third,
investment case viability. It costs a lot upfront to build this stuff. And the payoff might be uncertain, might take years. Hard to justify that spend for some firms right now.
high cost, uncertain, short-term ROI.
And the fourth, maybe the biggest, cross-industry consensus.
Getting everyone on the same page.
Yeah. On the tech, standards, rules, legal frameworks. Without broad agreement, progress stalls. You need that shared confidence.
Technical, economic, collaborative challenges all intertwined.
So looking ahead, the road ahead and calls to action, what are the priorities?
Interoperability comes up again and again, making sure different DLTs, different systems, different countries can connect and work together seamlessly.
Critical. And regulation.
Harmonization. Getting rules aligned globally based on principles like same risk, same activities, same regulatory outcome, and being technology neutral. Don't regulate the tech, regulate the activity.
A level playing field globally.
That's the goal. Avoid fragmented rules. The report also says more study is needed in areas like fractionalization, really understanding its impact and how best to do it. So, lots done, but still a long road with plenty of work and collaboration needed. Okay, shifting gears slightly, there was some recent news, Bitcoin depositary receipts, BTC DRs, from a company called RDC. How does that fit in?
Yeah, really interesting timing. Receipts Depositary Corporation, RDC. They launched these BTC DRs for qualified institutional buyers.
So for big investors.
Right. And what's interesting is they're using a familiar structure, the depository receipt, like an ADR for foreign stocks, but applying it to Bitcoin.
Taking an old tool for a new asset.
Exactly. Trying to provide a secure, regulated way for institutions to get Bitcoin exposure using a structure they already understand.
What are the claimed benefits?
RDC highlights the tried-and-true structure, direct ownership of the underlying Bitcoin, and fungibility. Institutions can swap between Bitcoin and the DRs.
And it's not just for Bitcoin.
They say the structure works for other alternative assets, too. They plan to create clearinghouse-eligible securities for other things eventually, bridging traditional finance and digital assets.
Who holds the actual Bitcoin?
Anchorage Digital Bank is providing the institutional custody.
So, sounds like a step towards making digital assets more palatable for traditional institutions within existing frameworks.
Potentially, yeah. It's aimed squarely at qualified investors for now, with all the usual disclaimers about risk and regulatory approvals, of course.
Okay, so let's try and wrap this all up. Key takeaways from the GFMA report, this RDC news. What's the big picture?
I think it's clear DLT has huge promise. Efficiency, new types of assets through tokenization, maybe wider access for investors, but big hurdles remain.
Regulation, interoperability, getting enough people using it critical mass.
Those are the big ones. Achieving global regulatory clarity and consistency, making sure platforms can talk to each other, and building those network effects.
And it really hammers home the need for collaboration, doesn't it? Industry, tech, regulators, all working together.
Absolutely essential. And maybe things like those Bitcoin DRs show an evolution. Finding ways to blend the old and the new, using familiar structures for digital assets, could be a key step forward.
So maybe a final thought for you, the listener. Given this potential and these developments like BTC DRs trying to bridge the gap, what completely new financial products might emerge as DLT matures? What new market structures? And how will the traditional players adapt or shape this evolution? Definitely gives you a lot to think about regarding the future of access, efficiency, and just innovation in finance.
For sure. Lots to watch.
Thanks for joining us for this deep dive.